Welcome to This Explainer. We're diving straight into the massive, kind of mind-boggling contradiction at the very heart of Meta's latest earnings report. I mean, on the surface, the numbers look like an absolute home run. But once you peel back the layers just a little bit, a totally different and honestly, way more complicated story starts to emerge. We all know they're navigating a massive transition right now. So let's just jump right in and unpack exactly what went down on Wall Street and why investors are reacting the way they are. So here is the wild contrast we're seeing. The core ad machine, Facebook, Instagram, WhatsApp, it is absolutely still printing cash. Revenue shot up a massive 28% year over year to $60.8 billion. That's a super healthy top line, right? But then you look at net income. A massive spike in costs dragged it down by 14%. The actual operating income for their core family of apps shrank. And for investors expecting those profits to scale right alongside that booming revenue, that's a giant, flashing red flag.
Section 1. The earnings paradox. Revenue versus reality.
Now, the real shocker wasn't even just that profit drop. Meta's free cash flow, the actual cash left in the bank after running the business, plummeted a staggering 91% to just $784 million. To put that into perspective, in the exact same quarter last year, they posted $8.55 billion. So this is the lowest free cash flow Meta has posted in at least 5 years. They basically took every single spare dollar they made and threw it right back out the door, just to keep the lights on and fund their massive new ambitions.
Which brings us to Section 2, the AI spending furnace, burning cash for compute.
So you're probably wondering, where exactly did all that cash go? Well, it didn't just vanish into thin air. It went straight into what we can really only describe as a giant AI furnace. Meta just raised the lower end of its capital expenditure forecast to a jaw-dropping $130 to $145 billion for the year. That's the money they're spending on hard physical assets. And get this, the upper end of that range is nearly double what Meta spent on infrastructure last year. We're talking absolute mountains of cash being poured into servers, sprawling data centers, network infrastructure, and those incredibly expensive, highly specialized NVIDIA AI chips.
Usually, when a tech giant drops that kind of money, investors want a crystal clear return on investment. But right now, Mark Zuckerberg is basically asking for blind faith all over again. He is actively eating into profit margins with zero guarantee of any immediate revenue growth to offset it. And honestly, this is making shareholders incredibly nervous. It feels a little too close to the whole metaverse pivot, right? Which, as we all remember, burned through billions without delivering those promised short-term financial rewards.
Moving on to Section 3, guidance and legal headwinds, the pile on.
Let's talk about the next quarter because the pressure is really building. Meta forecasts their Q3 revenue to land somewhere between $61 and $64 billion, bringing the midpoint to $62.5 billion. The problem? Analysts were expecting $63.2 billion. Now, I know that sounds like a tiny, almost rounding error kind of miss, but on Wall Street, missing the mark on guidance for a massive growth company almost automatically triggers a sell-off. And the cash burn doesn't stop with AI. The balance sheet took another massive hit with $2.4 billion in legal costs this quarter alone. On top of that, they're flagging some really serious lawsuits looming in 2026 regarding the mental health impact of Instagram and Facebook on teenagers. If those trials don't go Meta's way, we could be looking at material, multi-billion-dollar losses. And that would just absolutely gut their already shrinking cash reserves. Section 4. Zuckerberg's cloud pivot, a new revenue stream? So despite these massive hits to cash flow, and despite the impending legal battles, Mark Zuckerberg spent the earnings call fiercely defending his spending strategy. He doubled down on his long-term vision, literally telling investors, and I quote, "The people who invest in this will feel very good and be rewarded over time." He made the case that personal AI agents are going to become a mass market product used by billions of people. But then, right in the middle of the call, he dropped a much bigger bombshell. It turns out Meta is planning to enter the cloud services market. Yep, instead of just selling ads to fund their AI habit, they want to start renting out their massive AI infrastructure to other enterprises at a premium. Finally, a potential enterprise justification for that insane $145 billion capex bill. Meta is essentially gearing up to come right after industry titans like AWS and Microsoft Azure. But of course, there is a catch. On the call, he gave absolutely zero specifics on a timeline or pricing for this whole cloud venture. Right now, it is literally just a promise. And for investors who've been burned by the grandiose promises of the metaverse before, they're really left wondering if a vague promise of future cloud dominance is enough to justify completely wiping out their free cash flow today. Section 5. The Microsoft contrast,
Execution versus aspiration. To really understand why the market reacted so brutally, we have to look at the elephant in the room, Microsoft. They reported on the exact same day, which basically gave Wall Street a real-time stress test of two very different AI strategies. While Meta stock dropped 10% on their news, Microsoft's jumped 8%. Why such a huge divergence? Well, because Microsoft actually proved that their Azure Cloud unit and their Copilot AI bets are paying off right now. They cruised right past expectations and showed immediate revenue generation from their massive AI investments. Wall Street is punishing Meta because, as Forrester analyst Mike Pruels pointed out, they are spending way ahead of proven product demand. Unlike Microsoft, who is monetizing their AI as we speak, Meta is asking everyone to just hang tight for a decade-long timeline to see a return. And it's just a whole lot harder to celebrate AI spending when the costs are already showing up in the numbers and actively erasing your margins.
Section 6, the final verdict, a show me story.
All right, let's bring this all together. With Meta stock hovering around $585, which is down nearly 24% from its high, we've got to weigh the two sides here. On the bull side, the core business is undeniably strong. They are still the absolute ad king, pushing 28% revenue growth, and this new cloud pivot genuinely offers massive potential if they can actually execute it. But on the bear side, you just cannot ignore a 91% drop in free cash flow, the very real anxieties of a Metaverse 2.0 spending spree, and those looming legal threats. Right now, all of this makes Meta a highly volatile, show-me kind of story. Definitely keep an eye out for that promised cloud announcement in the coming months, because that is going to be the ultimate stress test for this new strategy. Until then, I'll leave you with this final thought to ponder. Is Mark Zuckerberg a misunderstood genius building the next massive enterprise cloud giant, or is he just repeating the exact same unbelievably expensive mistakes of the past? Thank you so much for joining me for this explainer.